Hi everyone. Share prices never move in a straight line, but do they move with repeating patterns throughout their time? Is it better, for example, to buy in one particular month rather than another? Or is there any truth behind stock market adages like sell in May and stay away? But are all these patterns just interesting correlations without the crucial causation to make them useful? Let's find out. I'm Anthony, and as always, we're talking money. Now, when you play the lottery, the national lottery, there are certain numbers that seem to come up more frequently than others. There's no good reason for this. In fact, it defies any logic at all. Why, for example, does the number 52 appear 1.5 times as frequently as, say, the number 48? And why have certain numbers not appeared at all for the last 6 months? So, would it be that much of a stretch to think that shares may move up and down, influenced by something other than just simple market sentiment for that day or month? Certainly there are patterns in share movements. In fact, charting is a well-established method of identifying these patterns. But what about the chances of shares moving up being improved if we, say, bought our shares in a certain month or week or day compared to another? Stick to the end of the video and I'll tell you the best performing day of the year. According to the Stock Traders Almanac, there is indeed a discrepancy between the months. They maintain that the best stock market returns of, say, the Dow Jones comes from the months between November through to April. This is also known as the Halloween effect. In fact, if you run data between 1950 and 2017 and bought the index in November and sold it at the beginning of May in line with this theory, then you would have doubled the gain compared with just buying and holding throughout this period. That's quite an impressive difference, and it can also be witnessed in 36 out of 37 key markets, with the strongest effect, funnily enough, being here in Europe. Indeed, there is some evidence that this discrepancy between returns from May to Halloween compared to, say, November to April can be traced back to the 17th century in the UK. History does indeed seem to repeat itself. But what about the individual months? Well, again, we can see some real discrepancies. September would, it seems, show a distinct drop compared with December, which historically has been the best performing month. The differences are small but distinct and give rise to those well-known expressions like the Santa rally or sell in May and go away. Of course, when these become the lexicon of traders and investors alike, they can become self-fulfilling prophecies and exacerbate the differences. Okay, so certain months may show a tendency to do better than other months, but what about days of the month or even days of the week? Well, according to Investopedia, stocks tend to do better at the turn of the month, and this could be explained by the monthly inflows into mutual funds, historically at the start of each month. This then leads to falls generally in the middle of the month. Fund managers also tend to buy at the end of each quarter to shore up their balance sheets. But perhaps one of the most renowned stock market historians was David Schwatz. I used to love reading his articles in the Financial Times that gave snippets of statistical insight into how stock markets moved according to indisputable but seemingly inexplicable rules. These rules simply seem to give a probability of future stock market movements. Some examples from his book entitled, I've got it here actually, entitled Daily Stock Market Trends Predict Tomorrow's Swings Today. Catchy title. He cites quite a well-known rule of thumb that the stock market often rises at the end of January, but less widely known is the observation that the stock market usually rises in the next 5 trading days if January the 27th gains at least 0.25%. Just bizarre, isn't it? Oh, by the way, this book is not a bedtime read. It's more of a sort of reference book. It goes through every single day of the year. Just pick one example here, for example, July 14th, the odds of a price increase is 49%. Well, that's roughly 50-50. But it also goes into saying what the statistical odds of a large rise, a small swing, a large fall, odds on a rise based on yesterday, and then goes into diagnostics of each day. And this is decades of information summarized into a very sort of handy sort of reference book, really. It's really quite remarkable. It gives graphs at the start of each chapter, chapter being a month essentially, and it gives graphs on, I'll just show you very quickly, graphs on how April performs, for example, and goes down each day as to the statistical probability that that day will see a rise in stock market prices. Anyway, more of this later. Or what about this little gem? October the 9th is the worst performing day in the year, in which stock rises only 33% of the time. Furthermore, stocks rise just 8% of the time on that date if the 20-day moving average is drifting horizontal as the 9th approaches. This is quite a remarkable statistic, and there must be some sort of explanation. Sadly, David Schwatz died in 2013, but he had a rare ability to make a fairly dry subject informative and interesting at the same time. At the back of my mind though, I have a niggling feeling of doubt that all these statistics and irrefutable facts and figures have absolutely no predictive power at all. It's a niggle because I can't get out of my head those lottery figure statistics that we started this video with. The fact that the number 58 in the lottery has appeared more often in the past doesn't necessarily mean that it's more likely it will come up in the next lottery. Put another way, if you were to toss a coin 100 times, I can almost guarantee that you will not have 50 heads and 50 tails by the end of it. Even though probability dictates that you should, the discrepancy is a statistical anomaly, nothing more and nothing less. But Schwartz himself identified another problem with relying too much on historical trends. He said, a frustrating aspect of trading shares is that the investment world is forever changing. Trading strategies that work well for months or even years suddenly just stop working. Not only that, but there are many smart investors who are quick to spot a winning approach and adjust their trading practice accordingly. So for example, a new short-term trend suddenly develops and a share began to bounce up every Tuesday. Eagle-eyed traders would spot the short-term profit window and purchase shares on, say, the Monday afternoon to catch that bounce. As more traders play this trend, money flows would change. Some money that once drove up prices on a Tuesday would now be committed on a Monday. With less buying occurring on that Tuesday, prices would more likely decline, not rise. Anyway, this is actually quite a handy get-out. It would explain in part why trends can be observed but never relied upon. As soon as you and others rely on them, then the strategy fails and a new one needs to be sought, which basically means that historical insights might be best observed and nothing more. This very neatly leads me onto the fascinating world of correlations without causations. You know the thing I'm talking about. To give you a silly example, there's a 94.71% correlation between the number of people who died by becoming tangled in their bed sheets with the per capita consumption of cheese. Bizarre. Or what about the 99% correlation between the consumption of margarine and the divorce rate in Maine? So correlations can exist without any possible causation. So it's not beyond the bounds of possibility that correlations exist in stock markets that exist simply by coincidence rather than having any cause or predictability. These correlations can exist simply by matching up data sets that coincide with each other. If you don't think that ludicrous examples can't exist in stock markets, how about the fact that the S&P 500 outperforms its historical average if an American appears on the Sports Illustrated magazine front cover, or the Dow Jones falls in the Chinese Year of the Rat, or my favourite, that women wear shorter skirts during bull markets. If a correlation exists and has had time to establish itself, is there any harm in believing that it will continue and become an aid to prediction? Well, to put it bluntly, in my humble opinion, yes, it is a problem. In my previous video called Why Experts Get It Wrong, I gave the example of tossing a coin and asking 1 million people to predict the outcome of 15 coin tosses. After that number, roughly 30 people would have predicted all the coin tosses correctly. The success is equivalent to those close correlations. However, to think that these 30 people have any greater predictive power than those who got the first coin toss wrong is just wrong, as thinking correlations will continue because they have been correct before. The only time we can rely on a correlation is if we also at the same time have some rational explanation and establish a causation as well. So let's just have another quick look at that Halloween effect, the one that says that better returns are from the months of November through to April. There are some causal reasons to explain this observation. One theory is that during the summer months when traders go on holiday, volatility drops, as does volume. One theory goes that the appetite for risk reduces in these times of lower volatility and increases in winter months as volume and volatility goes up. Volatility in markets is synonymous with risk. The higher the risk, the higher the potential returns. Although this may not be the actual reason, there is so much research that this phenomenon is real, there would seem to be some sort of causal link that may or may not be yet formally identified. Finally, one of the most reliable links in the stock market, and this may sound a little bit obvious, is that prices go up over the long run, with emphasis on the long run bit, on increasing corporate profits. How fast they go up may depend on other fundamentals like earnings growth rates, return on capital employed, etc. You know, the boring stuff like that. This is what I believe in anyway, and it's central to investing on the basis of looking at the fundamentals of a share or market. Things that affect those corporate profits will indeed reliably affect the prices over the long run. History will indeed repeat itself, but the key is to distinguish between correlations that are just interesting quirks and those that have real causation. Anyway, if you've made it this far in the video, thank you very much. But as I promised you, I said that I would share with you the best performing day of the year, and it actually turns out to be the 27th of December. This particular date returns positive returns 77% of the time, and this is data taking back to 1935 up to the current date. So there you go, if you're going to invest on any day at all, make sure it's the 27th of December. You may have some interesting correlations that you find profitable. If so, put your thoughts in the comments section. And if you've enjoyed this video, then hit that like button and subscribe if you haven't done so already. And you'll get updates on all the topics related about stock markets, economies and money. I'm Anthony, and as always, we're talking money. I'll catch you in the next video. But until then, bye for now.